Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. And the R word has been very much on people's minds lately, recession. We learned that in the first half of 2022, we had technically a recession. A recession is generally defined as 2 consecutive quarters of negative GDP growth. And in the first quarter of the year, the economy declined by 1.6%. Then in the second quarter, it declined by a fraction of 1%. So it was a very shallow recession. The Biden administration would like to believe there was no recession, and that it is unusual that you'd have a strong labor market and ultra low unemployment and a recession at the same time. But from a technical standpoint, we met the definition of a recession. So the question on most people's minds is, if we're in a recession, should they be out of the stock market? And my answer is no. Part of it has to do with the fact that the stock market is a forward-looking indicator. Investors don't care what happened last week, last month, last year. They care about what lies ahead next week, next month, next year. And typically investors look at about 6 to 9 months. Even the view 6 to 9 months out is always hazy, but beyond that, it's just too far to really predict what's going to happen to the economy or interest rates or corporate earnings. So the fact that we had a recession in the first half really has no bearing on what the stock market does from here. What stock investors are concerned about is, first of all, how high is inflation going to be? Obviously, we had a very big number when it hit 9.1% this summer. But if you look at the indicators in the market, bond yields are around 2.8%. That's awfully low for 9% inflation. Gold is down for the year. Gold is a traditional inflation hedge. Why is it down? Treasury inflation protected securities are very sensitive to inflation. They're down for the year. And if you look at the price of many commodities, they're also down. So what's happening is the market is clearly pricing in that inflation has peaked. Doesn't mean it's going to come right back down to 2%, but it's going to drift lower in the weeks and months ahead. And that's a good thing for the economy and for interest rates, because if the Federal Reserve, which has been taking rates higher at a rate of 3/4 of a point at a clip, if they're going to not have to take interest rates as high for as long, that's good for the economy, because higher rates make it more expensive for consumers to borrow and spend, make it more expensive for corporations to borrow to fund their operations or to grow. And it also makes it more expensive for governments to borrow. And let's face the fact that our government has an awful lot of debt, and so do other governments around the world. So it's a good thing that inflation appears to have peaked, and that while interest rates are going to go higher in the short term because inflation has been running hot, we're probably seeing the worst of inflation already, and it's likely to come down. So I would be very much inclined to not only stay in the market, but to take advantage of new opportunities as they become available. Each time I bought into the market sell-off, and each time I was glad I did, as scary as it was at the time, when you look back from the next recovery, it always seems obvious that you should have taken advantage of low share prices when you had them. In fact, if you're interested in 4 innovative stocks with a lot of upside potential, growing sales, potentially much, much higher profits in the future, I encourage you to pick up my new special report, which lists 4 great innovators with huge upside potential. So just click on the link below and it'll take you right to that report. That's it for today. Thanks again. Alexander Green here, Chief Investment Strategist of the Oxford Club. I'll see you next time.